You
can
guys see
see
my screen?
the hard money training class.
Awesome, awesome,
Okay.
awesome. Well, yeah, so today this class was really created because we wanted to dispel a lot of the myths, a lot of the false narratives, just a lot of the untruths that were attached to our industry. And we've realized a lot of folks when they're getting into this business, they're very nervous. They're very concerned about how are they going to get the money, and so we wanted to make certain that people really understood exactly how to go about doing that when you're looking to buy a property. In many cases, well, specifically renovate the property and then ultimately either sell it or in some cases keep it. And so that's what we want, why we created this class. We just want to make sure that people truly understand exactly the correct way in financing or obtaining financing for some of these projects. So who am I? Why should I be having this conversation with you? Why did Stacy ask me to have a conversation with you guys about this topic? Very simply, I am the managing director for Baker Collins and Company. We are a private lending firm based here in Atlanta. We finance residential as well as commercial real estate projects. We will fund renovation loans, new construction projects, rental properties, along with multifamily properties, and we'll finance, of course, commercial deals. A little bit more about me. I came to Atlanta in 1996, very proud graduate of Morehouse College and Georgia Tech. I also got a master's in finance at Harvard University, ultimately landed in investment banking. I was the guy who would raise money for commercial real estate projects, raising money for debt properties as well as debt as well as equity, and then kind of segued. Loved the business, was a big fan of. I love math. I love obviously financing. I love real estate. But we ultimately left that position and we started Baker Collins back in 2015. So that's kind of a little bit more about what I do and why I'm actually in this business. So have a great love, have a great passion for real estate finance. One of the things that we want to make sure that people truly understand when they're getting into this business is just some of the things that they need to do. So a couple of objectives today we're going to learn, and we're going to chat about what exactly is a hard money loan. You can ask multiple people, what is a hard money loan? And today I'm going to go back and forth. I'm going to oscillate between hard money loans and private money loans because of the fact that many folks, many folks want to make that distinction, but at the end of the day, you can use them interchangeably. But the big difference is many times when someone thinks of a private money lender, they're thinking of someone who has a little bit more disposable resources, whether it's a high income earner that has saved a good amount of cash and they're looking to invest that cash in a real estate project and get that cash back. But in my opinion, a private lender is someone who doesn't necessarily work within the public markets. And we're going to go into much greater detail about that as well. But we're going to chat with you guys about what exactly is a hard money loan. Then we're going to go into why would you use a hard money loan? There are numerous ways in which you can finance real estate projects, renovation loans, and things of that sort. But I'm a little biased, but we are going to go into detail as to why would you use one. Yeah, and we're going to compare it to some of the other ways in which you can acquire properties as well as for the renovation of the projects also. We're going to walk you through why would you use a firm like Baker Collins to fund your deals. Obviously, there's a lot of folks who actually are, if you Google financing for residential investment projects, you'll kind of pop up a number of companies that kind of do something similar to what we do, but we're going to share with you what really delineates us from some of the groups out there as well. And then, of course, we're going to walk you through some deal scenarios, my favorite part. We're going to tie all this together, and we're going to kind of share with you and walk you through some of the scenarios and some of the real life deals that we've completed. Then, of course, we'll share with you how easy it is to get pre-approved for a loan. It's a very simple process. Anyone can do it. There's not a lot of, it's not a very complex, nor is it a complicated process. So we'll walk you guys through that as well. And then, of course, questions and answers. So what exactly is a hard money loan? Very simply, it's really just a loan that's based on a hard asset, and a hard asset being real estate. I mean, you can ask multiple people what a hard money loan is, but at its core, it's just that. The loan is based on a hard asset. The asset is actually real estate that you're sitting under. The amount of the loan is really determined by the value of the collateral or the property. So when we, as a private lending group, when we look at deals, we look at two things initially. If these two things don't make sense to us, we're essentially going to say yay or nay to it. The as-is value of the property, and if there's a renovation or there's some type of construction component that's going to add value to this property, we're going to take a look at the after repair value. So those are the two things that we place the most weight on. We will look at other things such as the borrower's experience, such as the borrower's credit score, such as the borrower's liquidity or how much cash do they have. But for the most part, those are the two things that we look for: the as-is value of the asset and also the after repair value. And if we can say yes to those two items, we're going to move forward. Items such as liquidity of the borrower, experience, credit score, those items will actually dictate what the terms will be, but it will actually but we can still move forward with the deal, provided that the borrower or the individual who's looking for financing is comfortable with those terms. So one of the things our industry does is obviously we want to make certain that when we deploy capital, that we're deploying it in the most efficient and we were trying to mitigate risk as much as we possibly can. So we lend at certain LTVs in order to kind of protect our interest and make certain that when we're lending monies, we're doing it in a very safe and safe in a way that we feel comfortable with doing. So we're going to lend at industry set percentages, anything between 60% LTV, 65%, 70%, or 75%. Many times, most folks are going to be between the 65 to 70% as far as LTV, and that's 60 to 75% of the finished value of the property. And for some folks, there are some lenders that can go all the way up to 75%. But for the most part, most lenders are going to fall within that 65% to 70% scenario. That's essentially where they're going to be. And again, that's against the future value, against the LTV of the ARV, loan to value to the ARV. Our interest rates are going to start at approximately 4.99% to 13%. And this is one of the reasons why I'm a little on the fence as far as calling these hard money loans, because I like to consider them more private money loans. Many folks are completely unaware that for an extremely qualified investor, the interest rates can be very attractive. The goal is to try to emulate bank financing to a degree, or conventional bank financing. Now, not everyone's going to get that, but I want folks to understand that the interest rates are going to be a little higher as well. Now, one of the reasons why our interest rates are going to be a little higher than a conventional bank is because of the fact that we take on significantly more risk than a conventional bank. Case in point, if you were to walk into Chase Bank or Wells Fargo or Bank of America, all venerable institutions, all institutions that we have relationships with, all fine institutions, right? And if you were to ask them, hey, I need to finance, I have a property that I'm looking to acquire. In many cases, it's probably in a challenged part of town, and I'm going to assign an estimated budget to this asset. And hopefully I'm going to sell it for some price point in the future that's higher than it's worth now. There's just a lot of speculation there. And so many banks, especially for new investors, are probably going to pass on that offer of yours. We are in business because we do the deals that traditional banks or conventional banks will not touch for new investors. Now, if you're a little more experienced, if you have some assets, you have some liquidity, there are some banks that will actually provide credit lines and provide financing for some of these projects. But for the newer investor, the investor that's done less than 5 deals, for the most part, they'll actually come to a firm like ours to obtain the monies for these projects. Because we don't mind if the property is in a challenged part of town, as long as that part of town is appreciating in some way, shape, or fashion. We don't mind if the property has a significant amount of repairs needed to it. That's completely fine with us. That's why we lend at a certain loan to value. We don't mind that the value, you believe you're going to be able to sell the value for a higher price point in the future. That's fine with us as well. We have items, we have checks and balances in our offices that allow us to kind of mitigate our risk and kind of feel comfortable with lending that money to you. But our interest rates, admittedly, are going to be a little higher than a traditional bank. But because of the amount of risk that we're taking on, the interest rates are going to be a little higher as well. That said, the interest rates are still lower than they were pre-COVID. And so COVID did a number of things. March 13th of 2020 was a very challenging day for a lot of the folks in our industry. That was the day that former President Trump announced that this was a national emergency. And so within that, literally 2 weeks or so, the capital markets, the finance markets just kind of went into disarray. A lot of lenders, lenders fell into three categories. Within literally about a 2-month time span, a lot of folks some folks decided to just kind of shut their doors completely. Obviously, they were they were apprehensive about how things are going to move forward. They did not know the uncertainty of it all. They just decided to close their doors. The second group of lenders, for the most part, they suspended lending at the time, but they essentially they still kept their doors open, but obviously their lending was suspended. And the third group will change their terms. And what I mean by change terms, they increase their interest rates and they decrease their leverage amounts. And when I say leverage, it's a fancy way of saying they lowered their LTVs, meaning that they're trying to mitigate as much risk as possible. But a funny thing happened, literally, I would have said back in like August or September of 2020, things just started to get a little better. And so a lot of the folks that actually had changed their terms, now their terms are a little more attractive because a lot of investors who were out of the market for a couple of months, they came back into the market and they just kind of roared back into the market. So the fourth quarter for us as a firm and for us as a lending industry was very good for a lot of folks because a lot of those investors that had missed that time, they kind of came back. And I'm saying all that to say, because of all the activity, a lot of capital markets, a lot of lenders, their rates are now more attractive than they were pre-COVID, which is, if you think about it, it's counterintuitive, but obviously there's a reason for it as well. I'm just saying, letting everyone know that the market is very strong right now. There are a lot of folks that are buying properties. There's a lot of liquidity out there, and interest rates are as attractive as they're more attractive than they've ever been on the fix and flip side as well. One of the reasons why many people tend to come to a private lending group is because of the speed at which we move as well. And so even if you're able to obtain financing through a conventional bank, in many cases, they may not be able to provide financing within the time frame that you need them to provide financing in. If you're living in a major market, if you're investing in a major market, specifically for renovation loans or fix and flip loans, you're going to have to attach yourself to a financial institution that can close relatively quickly because you're competing with a lot of folks in your market. For the most part, you're not just competing with your local investors, you're also competing with the statewide investors. You're competing with a lot of national investors, whatever market you're living. If you're in a major market, you're also competing with international investors. There's a lot of folks that are out, across the pond. We finance folks, obviously in Germany. We finance folks in London. We finance folks in Australia that have a lot of eyeballs in a lot of major American cities. And so I'm saying all that to say, when you are working with a financial institution, you have to be able to move fairly quickly. So the average closing time is between 7 to 14 days from the time that you submit the file to a capital partner or to a lender to the time that you're able to close. You got to make sure that you're able to close in a timely fashion because of the fact that you are competing with a good amount of folks when you're in this market. And so again, that's one of the reasons why so many folks tend to find hard money, private money very attractive because of the speed at which we can move and which we can kind of deliver funds as well to you. To kind of break it down into five bullet points, our industry is essentially a group of folks. It's pooled private resources. For the most part, we don't necessarily we don't originate our loans through the public market. So I would argue 99% of the folks that are lending money, whether it's institutional or it's private, they're not attached to a publicly traded company. There are two that I can think of, but for the most part, these are either an individual who's decided to deploy his or her capital to a real estate investor to get a better rate of return than they would if they would put that money in another investment, or it could be a group of folks who decided to pool their resources together and they're just looking to, again, do the exact same thing. Or lastly, if there's an institution who has decided to finance deals that way as well. So our firm, we're institutionally backed. And so that's essentially why, where you see private money. Hence the reason it's pooled private resources. Our loans will always be in first lien position mortgages. It's very rare. I know that there's some hard money lenders that will do this, but it's very rare that a hard money lender is going to be in a second lien mortgage. It's not the most attractive position to be in as it relates to kind of the capital stack of mortgages, but 90, I would say a good amount of folks are going to be in first lien position mortgages, not second lien or third lien. It just, if you're in second or third lien, it just becomes extremely more riskier for a lender to do that. These loans are non-owner occupied properties. You as an investor, as a borrower, cannot live in this property in any way. And that was actually, there was a law back in 2010 by the name of Dodd-Frank, Christopher Dodd and Barney Frank. There was a couple of a congressman, and that got together in Congress decided to put that together. It was kind of a reactionary law based off of the 2007, 2009, financial meltdown. But you as an investor cannot live in this property. These are non-owner occupied properties. And I get this question asked a lot, especially in our offices. Hey, can I buy this property and live in one unit? Or, the answer is no. And that's because we always like to stay on the right side of the law. These are commercial loans, not consumer loans. What I mean by that is these are business purpose loans. Deanna had a great presentation prior to that. And so every individual that we lend to, you will have to lend. We only lend to the business entity. We do not lend to the individual, because exactly what Deanna said, we want to make sure that you're protected when you're getting into these investments. And we also want to make certain that our capital partners and our funds are protected as well. One of the benefits of it being a commercial loan is the debt typically does not appear on your personal credit report. We don't necessarily need items such as tax returns or mortgage or employment information or income verification. Those things, not to sound crass, are almost irrelevant to us. We place the most weight on obviously the asset, and we'll take a look at the borrower's credit. But because they're business loans, they're probably more than likely they should not report in your personal credit report. Now, it's not a guarantee that it's not going to report in your personal credit report, because in some cases, if you do default on that debt, then there's a strong possibility that the person who sells that defaulted debt, or the entity who can sell that defaulted debt, they may put that defaulted debt on your personal credit report. But as you have it, many private lenders just do not put that information on there. And the beautiful thing about that is many of our clients have millions of dollars of debt out with us. Not one iota of that debt is shown up on their credit report. So it doesn't affect their debt to income ratio. They can use their personal credit to go out and buy personal items, such as a home, such as a vehicle, such as a boat, such as XYZ, fill in the blank. And so that's one of the biggest differences between private lending and conventional lending. Our debt does not appear there. Our loans are essentially interest-only and amortized loans. The interest-only loans are more so the short-term debt loans. The fix and flip loans, the new construction loans, those are typically short-term loans. Anywhere between 6 to 12 months is when the loan should, we want you to repay it back. Now we do finance amortized loans as well. Those are more so what we like to call the stabilized assets, the permanent loans, the 30-year fixed, the 5-1 arms, 10-1 arms, things of that sort. But today, because we're going to be discussing fix and flips and financing for fix and flips, we're going to discuss the interest only, the short-term loan scenario also, so you guys kind of have an idea as well. And why would you use a hard money loan? Obviously, for so many reasons. Very quick to get pre-approved. When you are competing with other investors or to just get a hard money loan, you definitely want to be able to get it pre-approved fairly quickly. Those hard money lenders can pre-approve you within 24 to 48 hours. They're going to ask for a couple of pieces of information. You'll have to complete a very simple application, not a 1003. For anyone that isn't familiar with the 1003, that's a traditional mortgage application. Typically, most hard money lenders or private money lenders, their applications are going to be maybe 3 or 4 pages. They're just going to want to know a couple of pieces of information from you. They're going to also want to see liquidity. That's a fancy way of saying how much cash do you have available. They're going to want to see, in many cases, a personal credit score. And so those items are going to, if providing those items to the private money or hard money lender, that's going to allow them to pre-approve you. And it is wise and it's prudent for you to have a pre-approval letter before you start shopping for properties, because when you have that pre-approval letter and you start to shop for properties, you put yourself in a much stronger position when you're making offers. And I always tell a lot of our investors who come to us, always have that pre-approval letter available. So therefore, the seller that you're trying to buy a property from knows that you've been vetted by a financial institution for these funds. Again, the closings really is one of the biggest reasons why many people tend to come to us. We close fairly quickly. One of the challenges with us being in such a hot market is, again, admittedly, closings are taking a little longer, and that's because of the fact that appraisers are taking a little longer to get out to properties. Because there's so much market activity, so many of the appraisers are just kind of, they're behind. We've had appraisal delays for the last couple of weeks now, and that's just because, the market is just on fire right now. I just got back from this conference, and one of the things that they were preaching about was the fact that when we get appraisers, appraisers are trying to decide whether they're going to appraise this private money loan as opposed to this conventional loan. And many appraisers would opt for the conventional loan because they know exactly kind of what to do there. So as a private money lender, we have to find a very specific type of appraiser, one who understands how to appraise as is values, which most appraisers know how to. But then we also have to find an appraiser who knows how to appraise the after repair values as well. And that's kind of one of the delays, if any, for a hard money loan. And so, but even still, it's still much faster than a conventional loan because of there's less documentation that's needed for a private money loan or a hard money loan. So those are the items that kind of would need as well, as kind of segue to the next point. Much easier to qualify. So just fewer requirements in conventional funding sources. I can't stress you guys enough, because we only work with investors. We do not work with owner occupants in any way. If you plan on living in a property, we are not the firm, nor are we the industry for you. We only finance folks who are going to use the property as either an investment or they plan on selling it, or they plan on keeping it as a rental. That said, there's just not as many documents that we need. Do not need tax returns, do not need income verification, do not need employment verification. We do not look at DTI. We do not look at your debt to income ratio. Again, completely I would argue, almost irrelevant to us. We're going to provide more options to fit your projects. So the renovation component is a big one. When you come to a hard money lender or private money lender, they're going to provide you with the monies to buy the property, and we're going to give you the monies to renovate the property. You will have to have a down payment. You will have to have skin in the game, or equity, skin in the game as we like to call it. But we're going to give you the balance or the majority of the capital to do that. And so we want to make certain that when you get into these projects, you have the resources to buy them, renovate it, sell them if you desire, or keep them as a rental property, which so many of our clients are doing now as well. With a hard money loan, no matter where you're at, for the most part, all credit scenarios are considered. I don't like using the word, I never will say someone has bad credit. My thing is, someone may have challenge credit. Credit is just a snapshot of where you're at the current moment. It could change every 6 months depending on your activity or if your use of your credit. And so, but with hard money, with private money, we place the most weight on the property. And so credit is definitely a factor that we're going to look at. But throughout this conversation, we're going to share with you, even if you do have the most challenge of credit history, we'll share with you kind of a workaround or a way in which our industry would feel comfortable with kind of still financing your project if you did have challenge credit in that scenario. So I wanted to just kind of use everyone to see this infographic, because if you kind of boil it down, this is what a conventional lender would look at as far as financing. When they're looking at your deal, they are going to look at obviously 4 factors. The biggest thing that a conventional lender is going to take a look at is credit. If your credit score is, I think they can go as low as a 580. Someone correct me if I'm wrong, but if your scores are minimum is a 580, I think you start to get better pricing when it's like a 650 or 660 or something like that, or even a 680. If your scores are below a 580, unfortunately, you're kind of out of the game. You got to go back. You have to work on your credit. You have to go get that, fixed, resolved, and to come back to try to obtain financing from a conventional lender. Next, the conventional lender is going to take a look at verifiable income. How we determine verifiable income? They're going to want to see bank statements, sufficient bank statements, plus tax returns. They're going to want to know that you have the ability to repay that note back every single month. And the only way they can find that out is by bank statements, taxes. They're going to probably ask for employment verification. They're definitely going to ask for income verification outside of that. So they just want to make sure that you have the resources to repay back the loan. Next, they're going to look at the as-is value of the property. If the value is lower than expected, one of 2 things will happen. Actually one of 3 things will happen. Either you are going to have to bring more money to closing, or they will just cancel the deal because the value may be lower than expected, or you could just kind of walk away. I mean, no, actually, that's 2 things. And so with the as-is value, you want to make certain that the price point, or if you're buying a property, you want to make certain that the purchase price equals the as-is value of the property. Hopefully it does. And lastly, the property condition. You can make a strong argument by flipping the as-is value and the property condition. With conventional lending, again, banks do not like taking on more risk than they have to. And so with a bank, they typically want to lend money to a property that's rent ready or move-in ready. And if that property is not rent ready or move-in ready, let's say it needs a ton of work done to it, they're probably going to require you to get someone in there to finish, or require the seller, whoever signed that property to you, to complete whatever recommendations they deem necessary, the bank deems necessary. If that does not happen, there's a very strong case that you may not be able to close on this transaction. So that's how a traditional lender, for the most part, is going to view a deal, whether it's an investment property, whether it is a owner-occupied property. They're going to kind of place those factors, and those are probably going to look at that in this manner. Now, if you compare that to how we look at deals, we look at deals in a much different way. We place the most weight on the actual property. We look at the strength of the project. And I said earlier in the conversation, we look at the as-is value and the after-repair value. That's what we place the most weight on. If the as-is value equals the purchase price, we're fine. If it does not equal the purchase price, what that means, the buyer may have to make up the difference of that number in some cases. And the after-repair value, we want to make certain that the buyer is buying a property for hopefully what they can sell it for. So we want to make certain that by doing the renovation that they're proposing, it's going to affect, or it's going to change the value or increase the value to a number that they can sell and still be profitable. So that's what we place the most weight on. Next, we're going to take a look at experience. Private money lenders, hard money lenders, no matter what part of the country you're in, whether it's Los Angeles, California, Atlanta, Georgia, St. Louis, Missouri, Seattle, Washington, we place experience as arguably the most important factor in lending outside of the project. And the reason for that is because the experience of a borrower we look at experiences in a very similar way that a traditional bank is going to look at credit, because we look at it as, hey, the person who has experience, the person that's gone through the process of working with contractors, of working with realtors, of working with architects, of working with municipalities, and they've successfully exited out of a project, they are a less of a risk to us. Lending is nothing but a function of, it's risk to us as lenders. It's leverage to borrowers. So when we're deploying our capital, we're trying to deploy in the most efficient way with the least amount of risk. Conversely, as a borrower, you're trying to borrow as much as you can, so therefore you can reduce your out-of-pocket, your capital outlay, how much cash you're putting out. But experience is the number one thing that we take a look at. Now, how do we define experience? We define experience very simply. How many deals as an investor have you completed? How many deals as an investor can you share with us that you've taken ownership of, renovated, and then sold or kept, either sold as a for-profit or kept as a rental property? That's how we define experience. If you are a real estate agent and if you've listed, let's say, 50 properties over the last couple of years, that's awesome, but that doesn't necessarily count for investment experience. If you are a wholesaler and if you've wholesaled 30 properties over the last couple of years, that's great, but that does not count. If you are a general contractor, again, in a very similar fashion, does not count. How many properties can you show that you've taken ownership of over a certain time frame? In many cases, it was 24 months. Now it's 36 months. We just want to make certain that, and you can provide evidence of, that's how we define experience. And the reason why we use 24 months or 36 months is because obviously investing, lending, is a function of time. And also things change. The world was a little different 36 months ago, or even 24 months ago. 24 months ago, most people would have never believed that our country or the world would have gone through a pandemic. That's something that you hear that happened in the early 1900s. So that has obviously changed the way we will be doing business, and we'll be communicating, or we'll be interacting or interact with other folks for the foreseeable future, if not forever. In addition to the reason why we use that time frame of 24 to 36 months is because we've got new administration on the state level. We have new administration on the local level. We have new administrations at the national level. The price of materials and labor has gone up significantly. One of the biggest changes has been the cost of lumber. Lumber has gone up by almost 80% over the last, I would say, year or so. A lot of investors are starting to see those lumber costs that are skyrocketing. Now, I was told, and I read somewhere that it's starting to kind of adjust some for the good, but a lot of things can change in 24 to 36 months. So if you're an investor and if you tell a private lender, yeah, I've got a ton of experience, I've done a ton of homes, but they were back in 2008, 2009. Well, many lenders are going to say, well, I'm sorry, we're going to have to treat you as if you are a newer investor, because the world has changed significantly over the last 24 to 36 months. So experience is arguably the most important thing that we as lenders will take a look at, outside of obviously liquidity. So with liquidity, again, fancy way of just saying how much cash can you show? And so with liquidity, I personally would prefer that the borrower has approximately 30% of the total project cost. What I mean by that is if your purchase price is $100,000, your renovation budget is $80,000, your total cost is going to be $180,000. I would prefer to see 30% of that 180 available to you in some form or fashion. So that's specifically $54,000. 30% of 180 is 54,000. So we would prefer to see that, and we can see that in multiple accounts. So again, if we can see it in bank statements, that's great. Bank statements definitely give you. We're not going to discount that in any way. But if you show us like an IRA or a 401k or money market or stock portfolio or a bond portfolio, all those things count. We can take the aggregate of all of those accounts, whether it's a bank statement or whether it's a cash equivalent account, we can take the total of that to give the 30%. And the reason why I like to use 30% is because that 30% shows me four things. Number one, it shows me that you have enough money to bring to closing, because you will have to bring money to closing for these deals. And we're going to talk about what down payment looks like really shortly. But number two, it also shows me that you have the monies to start the renovation. So in our world, there's a thing called a rehab draw. So we're not going to advance you any bit of the rehab budget at closing. You're going to have to start the work with a portion of your resources, and then we will reimburse you as you go along. Once we send out an inspector and the inspector can confirm that the work has been completed. So we want to know that you have a portion of that rehab budget available to you. Then we also want to make certain that you have enough monies to make at least 3 monthly payments. And then lastly, after you bring the money to closing, after you've started your renovation budget, after you have paid 3 months of payments, we still want to know that you have monies to live. And so we don't want you to overextend yourself. Many folks will get into the business and they will overextend themselves. And it is our job as lenders to tell you, hey, look, this is a great project, but based off your liquidity, we think that you may want to rethink this, or maybe even bring someone in on this deal that can add more to your liquidity position. And then lastly, credit. I put credit at the top because there are a number of lenders that do have credit score cutoffs, but in many cases, there is a possibility to make an allowance for a credit score, a lower than expected credit score, if you have significant experience or if you have significant liquidity. But then there are a lot of lenders that do have a hard cutoff, and that's just the way they run their business. That's completely fine. But most folks, credit is something that we take a look at. And we are going to take a look at the actual score, but we're also going to take a look at the contents of the credit report. So things to look out for. If you've had a major credit issue, such as a bankruptcy or foreclosure that was recent, be prepared to provide a letter of explanation for sharing with the lender why the scores are XYZ, or why they are there. If it's been within 3 years, it's going to be very difficult to obtain financing. There are still some folks that will finance you even with a recent bankruptcy or a recent judgment, but you want to make sure you prepare that and share that with them early on. But and there are some lenders who are open to that, but your pricing is going to be much different also. So let's assume that you have challenges in any one of these scenarios or any one of these factors. Let's say you have brand new investor, you want to get better terms, and keep in mind, we as lenders, we will finance new investors. Everyone has to start somewhere. We finance a ton of new investors, but admittedly, the investor that has more deals under their belt, they're going to get more favorable pricing. But let's say you wanted better pricing. Let's say you didn't have a lot of liquidity. Let's say your credit wasn't that great. One of the beautiful things about what we do is because we only lend to an entity, we only lend to some type of a business, whether it's an S Corp, a C Corp, whether it's an LLC, you are open to putting or having more people join you on your business who may be able to add more experience, who may be able to have a little more liquidity, who may have better credit. So that's one of the beautiful things about working in this industry, is because we encourage you to collaborate with other investors. We encourage you to kind of have them as partners if you decided to do that. Some people are open to having partners. Some people do not want to have partners. And to us, there's no wrong answer. But if you do have any challenges in any one of these ways, you're open to doing that. Definitely get with Deanna so she can share with you the proper way of adding members to your existing LLC or your existing entity. I can't tell you what entity to set it up in, but obviously whatever entity you decide to, you want to make sure that it's properly set up with an attorney as well. But you have that option. And so that's why I always tell folks when they're getting into real estate investing, it's very difficult for me to hear that somebody does not want to get into investing. There aren't a lot of excuses. You've got a great platform like REI USA that allows you to connect with other investors where you may be able to kind of piggyback on their experience, their liquidity, and also their credit for that as well. Maximum allowable offer. So in our office, we like to, there's this thing that we call a PTW. PTW is a very, it's an acronym, just stands for a professional time waster. And so one of the things that we realized that a lot of folks can do to, minimize or the time that they work on these deals is just to do a very simple math formula. It's called the maximum allowable formula. This is an approximation. It does not work 100% of the time. All you're going to do is you're just going to take your ARV, you're going to multiply it by 70% or 65%. And the reason why we use 70% is because of the fact that you know that we as a lender, we're going to lend at 70% of the future value. As a lender, we're lending into the future. We're hoping that the value is going to be a certain number. So we're going to lend into the future. If you multiply that by 70%, your total cost for this deal should not exceed a certain number. If you back out your expenses, you know that your maximum allowable offer is this number. Very simple formula. And again, it is an approximation. It is not specific, but this is kind of where you would want to start when you're looking at a renovation loan, when you're looking at a renovation project. Before you go out to the property, before you start to kind of send over contracts, make certain that you just run this very simple formula, understand what the repair budget could potentially be. You want to be very conservative with your repair budget, because when someone is chatting with you or conversing with you about what the after repair value will be, all that means is what the property will be worth once it's fully renovated. You don't know this number. Someone is telling you this number. Now you can pull comparable sales to try to figure this number out, but again, it's still a shot until you get an appraisal done or until you feel very comfortable with the comparables that you're finding online, whatever multiple listing service you work with. This number is is the variable. And also this number, the repair budget, it's also a variable. But this kind of can give you an idea as to what you may want to pay for the property, because in our office, and what most lenders are going to do, they're going to run a variation of this formula when they're lending monies to you. And so the math is super simple. We just want to make certain that when people get into these projects, they understand what they're getting themselves into as well. Also, so very simple formula. Let's assume your after repair value is $200,000. Your ARV, you're going to multiply that by 70%. The total project cost equals 140. And if your budget is 40,000, you should not pay more than $100,000 for that property. You probably will want to start at approximately maybe 80 to 85,000 as a negotiation, but now you have data to support what you're offering. And so we just want to make sure that our clients really understand when they're offering and they're making their offers, always assume if you're going to use private money, you want to be able to kind of use that as well, because that's what we're going to look at also. So very simply, every one of you guys are doing a fix and flip in some way, shape, or fashion. You guys don't have to become general contractors, but I do want you guys to really have a working knowledge of what a draw budget looks like and a scope of work looks like. This is a scope of a line item budget. It kind of flows the way a fix and flip should kind of flow. You start with your permits, plans, demolition, things of that sort. It kind of gives you an idea as to what it would look like. You want to get familiar with what these items are and also what items you're going to need for fix and flip. I'm a big believer of working with general licensed contractors, especially if you're kind of newer to the business, but you still want to have this working knowledge of what these items are going to cost. If Stacy's open to it, we can send you guys a template of this. It's a draw schedule, line item budget, along with a scope of work template as well. We want to make sure that you guys truly understand what you're kind of getting yourselves into, especially with this market. By having this working knowledge, you'll save yourself a lot of time. You'll know what we need also. In every single renovation project, if you are working with a private lender, we will always need a rehab budget template. We will always need a scope of work. And the more detailed you are, the better it will be for you to obtain your draws. Again, we are reimbursing you your portion of your draw budget. So we just want to make certain that people have a working knowledge of this template. And I will send this over to Stacy, and she can send it over to the folks who are working on this. So you guys just kind of have this, and it's a really cool template. Just actually allows you to calculate a lot of the stuff there as well. So you can just plug and play numbers, and it'll populate the numbers for you also.
Awesome. Yes, we'll put that into the forms directory for everybody.
Awesome. Very good. Yes, we love that. We want to make sure that folks actually have that as well. So every one of you guys, at some point, you're going to work with a contractor, and I could do an entire another class on contractors, but we're not. We're going to talk about private lending. But one of the major items that allows you, one of the biggest drivers of a successful project or an unsuccessful project is kind of the relationship that you have with your contractor. So I'm a big believer of, when you're working with a contractor, do some very simple steps to kind of protect yourself. So when you're working with a contractor, always make sure you get their license information, you get their insurance information, and then you go to the Secretary of State of that state that they're registered in, and you try to check for some type of consistency. Obviously, I know Yana just spoke about registered agents and things of that sort, but you want to make certain that there's something that ties the license information to the insurance information. We want to make sure that our investors are working with their contractors, they know how to work with them. Then I would recommend that you get a contractor agreement. And obviously there's going to be a contractor agreement between you and them, but you also want to have your attorney go through that contractor agreement so you understand what are the roles and responsibilities as, number one, you as the investor or the borrower, and number two, the contractor. I would have those items spelled out in great detail, because you want to make sure that you don't prevent, or you're trying to prevent some type of issue down the road. Connect with an attorney that understands how to read contractor agreements. I would highly recommend you do this. I see the other side of the coin every single day. So I just want to make sure that you guys truly go to an attorney who understands how to read these agreements. Definitely connect with Yana on that as well. I'm a big believer of having contractors sign lien release forms. For anyone who does not know what a lien release form is, essentially when in my opinion, this is just my opinion, you should not pay a contractor for work that's been performed unless you are 100% satisfied with their work. And once you are satisfied with their work, before you pay them, you have them sign a lien release form, meaning that if they did put a lien on the property for the work performed, they've already released that for you as well. So highly recommend, again, you have an attorney go through that document also in your respective state, wherever you're at, just to make sure that you guys are protected as well. And then lastly, please make sure that you go to the contractor's job site. This is a relationship that you're going to have for 4, 6, 9 months. And so you just want to make certain what type of individual this person is going to be, because you want to go to their job site. You want to see things like, how orderly are they? How do they treat their subs? How do they maintain their business? How do they do things like that? So it's good practice to just go to the contractor site, and any contractor, especially in this market, should be worth their weight in gold. They are busy. And so just go to the site, make sure that you do have I don't want to say connection, but just make sure you feel comfortable working with this contractor. I can't stress that enough, because contractors can make or break a project. So we want to make sure that all our investors are successful when they're entering into these projects. New investors, here are some of the terms. If you're a brand new investor, you're going to bring about 10 to 20% as a down payment against the total cost of the project. These are for purchases, renovations, new constructions. Interest rates for new investors, because you're brand new, are going to start at 9%. They can go all the way up to 13%. What dictates someone getting a 9% rate to a 13% for a new investor, for the most part, is credit and liquidity. Credit and liquidity are going to be one of the biggest kind of reasons why these rates are going to change. The term, 9 to 12 months. When we do check for credit, we do not want to see judgments, liens, minimal collection items, no new verse credit issues. Loan amount $75,000 is going to be minimum loan amount. Maximum loan amount is $2.5 million. No income verification, no taxes needed, 10 to 20% as a down payment. You're going to need the last 2 full months of bank statements in almost every scenario. In addition to, we do lend to foreign nationals as well. So you just want to make sure that you do that also. And for experienced investors, things get a little more attractive. Now you're going to bring less money because you've gone through the process of working through this, and you're going to be rewarded for the successful completions that you've had. So everything essentially remains the same with the exception of this number. The interest rate is actually going to drop down for some extremely experienced investors. They're going to start at 4.99%, and it can go all the way. This number is a typo. This should be 13%. But those are the biggest things that will change. And for some extreme experienced investors, certain things can be done for experienced investors, such as interest only being charged on the drawn funds for the project, and also deferred payments for experienced investors also. So things get a little more attractive when you do have a couple more deals under your belt as well. So just want to make sure that you guys do understand that as well. Why use Baker Collins? Very simply, we're a private lending group here in the Southeast. We financed well over 1,000 deals since 2015. We look at all credit scenarios, all experience levels are considered, all liquidity positions are considered. For us, we lend in 44 states. There are less states that we lend in as well. We do not lend in Idaho, Wyoming, North Dakota, South Dakota, Montana, or Alaska. And so those are the states that we, unless you are in those states, my apologies in advance, we just don't lend there.
Why?
Yeah. Why? The laws. They have interesting laws, and also just the population sizes. Typically, we like to be in markets where there are major, there's a good amount of folks and also job growth. There aren't a lot of industries in the North Dakota and South Dakota. I think there's one city in Montana that has like it's the most populous. I forget the name of the city of Montana, but it has more people in that one city than it has in the entire state. So these
I'm sure it's Grand Rapids. No, that's not Grand Rapids. Well, Idaho, Boise's the fastest growing city in the country.
Yeah, but outside of Boise, there's just not much going on.
Idaho's like the most beautiful state in the country.
I agree. Aesthetically, beautiful state. But it's just a challenge in some of those states, just because of just the there's just not a lot of activity there, and we have a finite amount of money that we can deploy. So we'd rather put that monies in states that are more populated than others. That's one of the reasons. It's just not us. You find that with a lot of other private lenders as well. They will have in many cases, they will block these states off as well. Just more so, the biggest thing is really just population.
Okay, well, we got some questions. Let me ask those to you.
Right.
Okay, first one is, let's see. Is for clarity, yes, okay, well, you went over this, but you loan to an individual investor personally or to their business? Because my LLC doesn't have a credit score.
No problem at all. Your LLC does not need to have a credit score. That's one of the biggest fallacies in our industry. Business credit is a great thing to have, but it's irrelevant to us in the private lending world. Your business credit does not need to have a credit score. We will look at your personal credit to get obtained. So we're going to lend to the entity. You are going to be a personal guarantee of the entity or that particular loan. But we're going to look at the individual's personal credit to get them qualified as well.
Okay, I've run into tons of properties lately that won't even show till under contract. And to go under contract, I need proof of funds. My realtor tells me that pre-approval is not good enough. This has been a huge roadblock for us.
So, very good question. I would recommend that they get pre-approved. Any private money lender should be able to provide them with a pre-approval letter or even a proof of funds letter. That language is obviously, it depends on which firm you're working with. And we have never had an issue with our pre-approval letters or our proof of funds letters. So I'd recommend maybe change the language from pre-approval to a proof of funds letter. I would never send if they're asking you to see, if they're asking to see like a bank statement showing liquidity, I personally wouldn't show that to them. That's just my opinion. But they should be able to accept a pre-approval letter or a proof of funds letter from a reputable financial institution.
Okay, one more question. What if we lack experience, but we have people in our team with extensive experience in all facets of real estate? Can we leverage the experience of the relevant team members to help us get a better interest rate than out of a newbie?
Very much so. We do that all the time. If any member of the entity owns more than 20%, they will have to be underwritten. If they do not, if they own less than 20% of the entity, then in many cases they will not have to be underwritten. Underwritten essentially means that many lenders are going to want to see a credit and background check of each member owning more than 20% of the entity. But yes, number one, most lenders can lend to new investors, but if you want kind of more favorable terms and you have people in your team that actually have more experience, by all means, you can definitely leverage their experience to kind of win that or obtain better terms or more favorable terms.
Okay, I think that's all we got. I think that's all I got, Kenneth. I appreciate it. Thank you for coming to hang out. And also I wanted to say too, like I've known you for a while now. And I remember back in the day, you were like, no, I'm not doing any presentations.
Yeah.
You're getting so good at it.
I love doing it. I found a new passion. I love teaching. It's super fun. It's, you know, I love seeing when people just really, I love dispelling the myths because there's a lot of myths in this industry and it's not hard to get. It's just, it is a process. It's new for a lot of folks and that's fine. We just love kind of sharing this information with a lot of people in the industry.
Okay, good. All right. Well, thank you so much for coming to hang out with us. Thank you for sponsoring REI USA. And I highly recommend working with Kenneth. I've known him for a long time. So just reach out to him and, you know, he'll answer any questions, you know, and, you know, maybe you can get some money from him.
Please do. Please do. Give us a call when you can. We'd love it. And again, thank you for having us. We always have a fun time with you guys as well. Always have a fun time.